As we get the call started here, let me know in the chat if there are specific concepts that you want me to cover on this call. I got some good thoughts from Lita. I could definitely cover that on this call about when to enter, having that confidence so that you're not chasing the market, you're also not waiting too long. What things are we looking for before we get into a trade? Let me know other things, especially as it relates to the market open call. The first priority of these calls here that we do on Saturdays is to explain the terms that are being used on the market open call. And Ryan uses a lot of different advanced terminology. And so we break these down, we simplify those terms, but we could also cover other things to help you specifically in your trading journey because it's all valid and it's all necessary, right? Like even when to enter, that's a part of what's shown on the market open call, but we could focus on that specifically. I'll go ahead and pull up a trading view here for us. All right, I'm going to share my screen. So what I'll do while you guys take a moment to think about what concepts you'd like me to cover, I'll start with the first one that we got today from Lita, which was knowing when to enter. When should you have confidence? What are things that you want to see on the charts before taking a trade? Also making sure you don't miss out on too many trades. Okay, so Christine, I think that's also a great addition to what we're going to talk about. I'll make sure I include that because timing is very important on even entering onto the NASDAQ. So the first thing you want to look at is could train to have understanding, right? The purpose of this call is understanding. It's right. Like I'm not going to just tell you what to do. I'm going to explain why. Why are you doing that? So everything is based on structure. Everything. It starts with structure on looking for an entry. And when you're determining a take profit on when to close the trade, that's also based on structure. When you're deciding where should I take my stop loss, that should also be based on structure. Everything's based on structure of price. Everything in trading is based on structure. There's a lot of different terminology in trading, but it's all describing different parts of structure, right? Like your fair value gaps are gaps in structure. Your order blocks, those are blocks of structure. Your break of structure, obviously that's when structure gets broken. Change in state of delivery, that's referring to structure. Liquidity sweep, that's referring to structure. Everything is based on structure. So in terms of your bias, your directional bias, which before you enter a trade, you should have directional bias. You need to have a bias. So we'll show, look, okay, like it has your, do you have a bias? And then has your condition been met to get in on that bias? It's based on two things, and I'll try to make this as simple as possible. So this is gold, and we're currently looking at the 15-minute chart. And I'm going to give you real-time analysis, meaning let's really look at this chart right here on gold. We know that every day a chart looks different. Some days there's a really strong trend where price is going in one direction, and then other days look like this, which I would describe as very choppy price action. Very choppy, where it sweeps up, sweeps down, sweeps up, sweeps down. Okay. So I'll take you from beginning to end on knowing when to enter into a trade. We're describing the type of chart that we're looking at. We say, okay, this looks choppy. Choppy charts are very difficult to trade. So if it's difficult, then you want to figure out a way to get to a chart that's not choppy. Now, if you're trading gold or you're trading the NASDAQ and you're like, well, I want to trade that, but it looks choppy. Well, that's where you should check out different time frames. Because this is the 15-minute, just because the 15-minute looks choppy, other time frames may not look as choppy. So let's start from the daily. Okay, this is the setup here on like when do you get into a trade? Well, first you have to have a bias first, right? Like what direction are you focused on? What is the higher time frame narrative saying? What's the real trend? In order to determine that, you gotta look for a time frame that doesn't have a lot of chop because that's gonna make it clear. Okay. Now, if we go to the daily time frame, that's testing another time frame here, right? Ryan also looks at the daily time frame. We go to the daily time frame, we could see that gold is currently bullish, but in terms of timing on the daily time frame, we're currently experiencing a pullback to the downside on the daily inside of a bullish trend. So let me explain why we're bullish. Okay, this is why we're bullish. I'll show you by tracing the big structure points that create the trend. So we have a big swing high here. That's a higher high, right? That's the highest high. Then we have a higher low right here where you could see price tried finding support, but it failed, creating a lower low. And this lower low right here broke this structure to the left, which was a previous higher low. So you got to look back at history before determining the trend. Okay, this is the process. I'm breaking it down. How do you start narrowing down your focus? You have to start very zoomed out and map your way into zooming in. So we're starting on the daily time frame. Why are we going to the daily? That's a very high time frame. Why? Because we were on the 15-minute, it was very choppy. And so we know as we start to zoom in, it's going to get choppy. So that means if we need clarity, we're going to have to zoom out on this one. Now, you don't always have to look at the daily because sometimes the 15-minute is very clear. It's not choppy. It's very one directional. There's an obvious trend, right? So that's where every day is different. So based on today, based on the way gold looks today, I got to zoom out. Okay, we're going to start with the daily. Let's look to the left and look at history. We were obviously in a strong bullish push up, and then price started to break down where this higher low failed. We came down creating a lower low. Why is that a lower low? Because it closed below the previous higher low. Okay, so now let's start following the trend and let's see what took place. So this is the lowest low on the chart. That's an important place of structure. And when you get a lower low, now the key is let's look for the last lower high prior to the lower low forming. So we know that this is the lower low. This failed attempt, which tried making a higher low and failed, causing price to go lower than the previous higher low. This is what shifted gold from bullish to bearish. Okay, so that means we went from bullish, pulled back. If it were to find support here and continue up, we would have stayed bullish. Because that failed, and we ended up dropping and closing below that higher low, that was a change of trend on the daily from bullish to bearish. Got it. So now we're saying we're bearish on the daily based on the most recent price action that we're mapping out here. You have a lower low, and this would now be the lower high. Price ended up holding at that lower low. It never went lower than that. And it ended up swinging up and closing right here back above the most recent lower high. So guess what? This push up right here shifted the trend back to a bullish trend. Okay, so now we're bullish again. Price came down and found support above the previous low to continue up and continue the bullish trend. That means that this right here reinforced the new bullish trend. So then if price starts to hold support, we start thinking, okay, it's holding support now on the daily. We have a new bullish trend. If the trend continues, then we know that we should take out the most recent higher high right here. Price should go above that. And that's what happened. Okay, so I'm mapping it out for you guys and I'm showing you. So here's the higher high because we closed above this previous lower high. Now we're finding a higher low based on this low here, which was the last point of structure. This one here doesn't count. Why? Because there was no break of structure to the upside and there was no break of structure to the downside. So this little pullback right here is completely irrelevant. We don't count that as any structure point. Okay, you always go from the high and the low. If there's a new structure point in between a high and low, that's not a new structure point. That's just noise. That's just continued price action. We don't count that. We're only looking for the highs and the lows, not the pivot points in between those highs and lows. That means you can only get a new high or a new low if a previous high or a previous low was broken. So following right along, this became a higher high. Once it broke that previous lower high, we came down. And because this high was broken, now we can look for a new low. Price came down and formed a new low, causing price to come up and close even higher. So now if we're following along with price on the daily, we say, well, then where are we at right now? Well, this was the most recent higher high. That's the highest point in the recent trend. And it's coming off of this low right here. That's the range. Right? I'm being very thorough here. So now check this out. We have this candle body high on the daily. That's the high. Now let's look at the low. That's the low right there. Okay. Now, personally, this is where you might find traders who use different rules for their structure. I use candle bodies to determine my highs and my lows. I don't use the wicks of the candle. I use candle bodies to determine structure, not wicks. And why is that? That's because for me as a trader, the way I trade, wicks to me are not a good ingredient to determine highs and lows because they're full of manipulation and fake outs and liquidity grabs. To me, those types of manipulative price action characteristics are not good to use for solid structure. To me, where a candle closes in that period is what determines the real structure. It's like, where did it close, right? Because you could see, for example, on this low right here, you could see price kept sweeping down, but closing back above. How many times did price sweep down? 4 times. And it kept closing back up above. So that tells you that the real structure is holding up above higher than the sweeps. These sweeps are just manipulation, right? You have this swept down, but then it closed back up here. This swept down, but then it closed back up here. This also penetrated and swept down, but it closed above the blue line. This also swept down, but it closed above the blue line. Okay, so that tells you that if you look at the candle closures, they're closing higher and higher above the lowest body candle right here to the left. Now, going back to the big picture here, okay, we know that we have a high and a low. Let me get rid of the brush and let's just stay looking at the range. This is the new range right here on the daily. This is the range high. I could actually move that down a little bit right there. That's the accurate range high on the daily. And this is the range low. So we're mapping this out, right? And all of this leads to like, when do you know to get in, right? If you want to be really accurate on when to get in, you got to look at where price is at. So here's the bias right now. Now we're saying, okay, we know the trend. We're bullish, but we're experiencing a very obvious pullback. You have this big wick here. You have this push down, followed by it came back up a little bit, swept high again, got pushed down, came down, found some support. Buyers still tried pushing higher. These buyers got rejected. The price came back down. Now you have a big daily closed candle right here. This is what's called a liquidity engulfing candle, which is very indicative of price continuing to the downside from this point. Why do we think price is going to continue down here on the daily time frame? Because this whole area above was tested by the buyers and rejected by the sellers. That means buyers tried pushing up higher, and that's why that wick goes all the way up there. They all got rejected, and the bears said, "Nuh-uh, we're bringing in the sell volume here, and we're ready to continue selling off." So I think next week, right? Today's a Saturday. I think next week price is going to continue lower at the beginning of the week on the daily time frame. I think it's gonna push down like that. Got it. Okay, so daily is telling us we're probably gonna see some continued sell-off to the downside. Now, how far can price go? Well, we know that it could go all the way to the bottom of the range, which is down here. That would be a massive sell-off. That'd be a really good sell to catch on gold. When the market opens back up, if you could find an entry on gold to take shorts, there's a lot of potential for a massive gain to make money selling gold. Now, let's be conservative and say, okay, will price make it all the way back down here? Well, maybe not. Why? Because we're in a bullish trend. Got it. So then that means price is most likely going to find a higher low than the previous low. Correct. Well, then where's that at? Well, looking at structure, you look at the last internal pivot of price, Let's use our eyeballs to determine this. Look at price came up right here, started to reject down and find support above here. So now I always say this to you guys. Levels of resistance become support. Levels of support become resistance. So if we look at the last level of resistance, we could see, I'll show you right here. Let me mark it up for you. Here it is. This was the resistance right here. That's an internal level of resistance on the daily. Now, all of this right here, there's no significant pullback at all. This is pretty much a straight shot to the upside on gold through this price action. This right here was not a straight shot. Price came up and then actually went bearish even more before finding support. So this was a valid area of selling off. Price had to shoot up real strong to break through that. But you could see that price never came back to retest the other side of this. That means this resistance has not been used yet as support. So now I'm starting to narrow this down. I'm thinking, okay, where's a valid area of price to run to as a target on the daily? This level right here. This would be a reasonable level for price to get to find support at this level to form a new higher low to continue to work towards that bullish trend to go higher high. That means I can expect next week gold to sell off to this level right there. And then it's going to start finding support and it's going to start pushing back up. And then as it pushes back up, if the trend continues, we should go back above this previous high and create a new higher high like that. That would be very reasonable to expect. Okay, so if you're mapping that out, you're thinking, okay, how am I going to trade gold next week? We're probably going to sell down. We're going to and why are we saying we're probably going to do this when we don't really know? It's because we're just following the trend. That's all we have to go off of. We're saying, well, we know the trend, so let's assume the trend is going to continue. That's really one of the only mild assumptions that you could make in trading. You know that the trend is your friend. Don't trade against the trend. The moves that go with the trend are always stronger than the moves that go against the trend. What does that mean? It means that this move down is going to suck because it's going against the trend. That means it's not going to just be a simple straight sell-off. That means, yeah, it's probably going to go down, but it's going to be very choppy. That means that if you're in sales, it's like scary. It's going to be like, go here, sweep back up again, scare you out, come down, come back, sweep up again, come down, sweep up again, come down. And it's doing what it's supposed to do, but it's going against the trend. So it's going to suck, right? When you're trading with the trend, usually it's a smoother experience. Price moves more fluidly with the trend. Okay, so it's going to suck on the way down and it's going to start finding support probably at these wicks over here first before it reaches closer to the actual candle body level, which is more valid for it to continue up. And on the way up, if the trend continues, it'll be smoother than what it was on the way down. And there's more potential for bigger trades on the way down. Got it. Okay. I could live with that. All right. The daily is pretty much fully mapped out. We see the highs, we see the lows, we see where price is probably headed to next, which level on the pullback. Got it. Now let's start moving down because the daily's done. Okay. Now I could do this process super fast. Like I could do all this in a minute, right? I'm going step by step. Here's the 4 hour. Okay, the 4 hour is currently bearish. So the 4 hour is ready to continue to sell off. Why do I assess that? Well, let's look at history. You have a higher high here, which was causing the 4 hour to be bullish. This was a higher low. We're continuing the bullish trend, but price got cut short, didn't make a higher high. It failed and it started to reject and it ended up closing here. Actually, looking at this, we're still bullish, but it's selling off. So it has some really strong downward momentum is what I should say. That's why it's important to track. Okay, what I do, I don't have to draw this. I could use my eyeballs, but for the sake of the class, I'll draw this out. So this is why actually we're still bullish when you zoom in even closer on the 4 hour. You have a higher high, and this is a higher low right here, and you have structure right here. So this whole zone right here is actually the higher low. That means that price can still sell off here and still find support on the 4 hour right here and then go up. Now, it's like there's so much information here in trading. Gold loves to sweep out highs and lows because it's looking for liquidity to continue its trend. When I'm looking at this chart, I'm going, okay, you have a lot of structure right here where price was really struggling, but then you have this gap right here. So I'm looking at areas of confluence and we're down on the 4 hour chart. I'm going, wow, this is actually strengthening my analysis that this level is a good level to look for buys on gold because this is not a really clear structure. This was a struggling area on gold, which tells me that price can easily wipe that level out, fill this imbalance right here, this fair value gap right here on the 4 hour to continue up. Okay. So we have strong momentum to the downside on the 4 hour, especially with, again, we have another liquidity engulfing candle, bearish liquidity engulfing, showing that we support further movement to the downside like that. Got it. Okay. And I don't need to really make any new structure lines because we're, this is still supporting the daily levels here. There's really no new lines that I could put here. The only line that you can add would be if you take this internal low right here, if once price gets below that, like let's say you took a sell right at market open right here, you take a sell. Once price closes below this level here on the 4 hour, you could go to break even. That would be a protected trade because you have an additional zone that price has crossed over and closed underneath, which should protect trades that are up above that to remove the risk from any trade, right? But we don't need to mark that up. Let's continue to move down. Got it. Let's go to the 1 hour. Okay. Now I could say definitively that the 1 hour is actually bearish. Okay, so the daily and the 4 hour are currently bullish. The 4 hour has a strong push to the downside, but it is still bullish. The 1 hour is officially structurally bearish. And that's just if you just track price, you have the higher high here. You have a little weak structure right here that was also broken. You have a stronger structure right here, more of a V-shaped structure that was also broken. This candle closed below that level. So we are bearish on the 1 hour. Got it. So now what I would do, and if I'm being very thorough, again, this is something that you could, like, if you watch the recording of this training, you can go back, you practice what I'm doing here as I'm marking up the charts. You could practice this and you'll find you could actually do this in less than 5 minutes on your own. All right, I'm gonna add a line here to the 1 hour. Okay, so we have the 1 hour high right here. I'm gonna change the color of that to green. I like using different colors for different time frames. And then we have a low that was broken right here, right where price is at. It just got broken. Got it. So the 1 hour is bearish. Now it just broke, so we know there could be a pullback up into this 4 hour daily 1 hour zone. There's a lot of structure up here to protect price to continue moving to the downside. Okay, so we just broke. That means we could easily open up on Sunday night and get up close to this area before moving back down like that, right? We're just looking at possible ranges of price. Got it. Now let's drop back down to the 15 where we were, where price was super choppy. But we needed clarity. We needed to see like, wow, this is really choppy. Right. You need to zoom out a little bit. Okay. So now we have our zones marked up. We have some nice daily zones, some nice 1 hour zones to show us what's happening inside all of this chop on the 15. Now we can come back here. There you go. Okay, so we could see going to the lower time frames here that I'm gonna add another line here for you to show you. You have this high up here. Okay, and I'm gonna change the color of that to pink for the 15 time frame. We have that high followed by this big low down here, right? You can see that on the 15, we're kind of already in a discounted area of price. That means if you take the 50% level, I'll show you right here. And again, bear with me, guys. Okay, bear with me. I'm going step by step here for you guys. So I want to show you how I mark up my charts. All right, this yellow line going across, that's the 50% equilibrium of the current range on the 15-minute chart. That's the 50% equilibrium. So what does that mean? It means, again, we're thinking of premium and discount. We're thinking of, is price low or is price high? Okay, is price low or is price high? So let me ask you guys in the chat, based on these beautiful colored lines that I put on the chart, you have the daily, the 1 hour, the 15, the 1 hour, the 15. Based on this lower time frame range, are we currently at a premium of price? Is price high? Or are we at a discount where price is low? Correct. Price is at a discount level on the lower time frame. Correct. So if price is at a lower time frame discount, that means that where is price going to go to next? And I'm helping you. You walk me through this. Where's price going to go from here? Okay, maybe to the lower reddish line, right? But remember, we're in a discount. Where does price like to go from discounted areas? Retrace. Okay, what does that mean? Lead a retrace up or a retrace down? Correct. Up. Okay, so the correct answer, because we're only considering this magenta pinkish line down to this magenta pinkish line. The equilibrium is the yellow line. We're in a discount zone, which means we just broke an hourly support level. The market is overdue for a pullback to probably go back up. And when price goes back up, it's gonna either retest this level here, or it could go all the way up to this daily level. It could go up to this 1 hour level. Heck, it could even go back up to this 15-minute range high. But what you want to see for an entry is price to reach one of those four levels. Obviously, the higher up you go, the better it is for a sell, because you move further and further up into the premium side of price. Okay, now I can expect price to probably go up to about here, maybe sweep that level right there, and then do that. I wouldn't just short gold on market open. This is telling me to wait a little bit. Why? Because you have to look, price is super choppy. So you have to assume that that's going to continue. But we just had a big drop. That means it hasn't chopped back up. That means it needs to come up into this imbalance area to continue that movement to the downside. You see, drawing this on your chart, if you practice getting your drawing tool and drawing out these different lines like this looks reasonable. This doesn't look out of place. This continued price movement looks like it's continuing what it's been doing. This is a reasonable expectation. Okay, so we're like, all right, pull back. but we're probably going to be coming down. We are bullish on the higher time frames like the daily and the 4 hour, but we're currently in a pullback. Got it. Cool. And that's how you start to narrow it down. You could go all the way down to the 1 minute now. And on the 1 minute, you could look for a rebalance trade. Okay, if we're expecting a pullback to the upside to follow along the daily and the 4 hour bullish trend, you could look for a change in state of delivery to go up from this level. So let's mark that up now. I'm going to erase all the lines. Okay. Now we're like, all right, now where do we get in? What do we do? What's going on here? All right. Let's look at what Ryan would use on when do you know to get in? Now that we have our levels marked up, when do you know to get in? On the 1 minute, this is the lowest low right now, most recently. That's the lower low coming off of this lower high. That's the 1 minute structure. All of this right here is just noise. It's inside the range. So we're currently bearish. You do not want to take a buy if the 1 minute is still bearish. That's the lowest time frame that we trade. You want to at least get a shift to a bullish trend on the 1 minute. That means price needs to come up above this level right here. So this would be our entry now. We're getting really close. It would go like this. Boom. That's the level right there. I'll make that yellow. Okay. If price goes up above this level here, we could take a long like this. Okay. You see Ryan do this all the time. And go to at least the first level of the retrace, the first level of the rebalance on the way back up. This would not be a bad trade. That means you could literally mark this up right now on your gold chart. And when Sunday market open comes back and the market kicks back on, you could look at this as a potential entry. Now, I wouldn't trade within the first 1 or 2 hours of market open because price is very unstable at that time. But going into Asia's session on Sunday night, if price is still bobbing and weaving and bouncing around here, this could be a valid trade setup where we're looking for a pullback to one of the higher time frame levels that we marked up before to catch a rebalance trade and scalp a winning trade on the way up. And that's how you find, okay, when do I get in? Once you have a candle closure above or below the most recently narrowed down time frame structure. That's when you get in. That's when you should have confidence. You say, okay, there it is. We closed above. That means we're a new trend on the 1 minute. Let's see how long this new trend lasts. Okay, you set yourself up, trade into the rebalance, and then you do the exact same thing to find your way back down, to follow that narrative of a pullback on the daily. So now I'm setting you guys up for this upcoming week. That means price can easily go like this, come up, and then we would look for a new trend to form going back down. So for example, if this was a higher low, this was a higher high. Once we break back down, now you could grab shorts up here in this premium side of price, this premium area, to write it back down. But your intentions would be very different this time. If you get into shorts up into this area, and let's say you just want to trade going up, trading longs into the rebalance, and I'm telling you your intentions, your outlook should be different if you end up getting into shorts up here. Let me ask you, what's different about your intentions on the way back down? Why am I saying that your intentions should be different for this trade compared to your intentions into this trade here? Why are those two different trades? Besides the fact that one's a buy, one's a sell. But why is the outlook different for those two potential trades? Exactly, Joy, counter trend. But let's elaborate on this. Okay, I'm giving you guys wisdom here. We know that we could take a trade going long on gold. It's valid when market opens back up to go up. Got it. We don't have a lot of room to go back up. Why? Because we're currently in a strong pullback to the downside on the daily time frame. We've already assessed that there is currently strong momentum to the downside. So if you're going to buy into that, you got to be really careful. Okay, gold overall is conflicted, and that's why the 15-minute is so stupid choppy. Why? Because you have a daily trend that's bullish, you have a 4-hour trend that's bullish, but both time frames have massive momentums to the downside right now on those higher time frame trends. And the lower time frames are bearish, right? The 1 hour and below is bearish. So you got to be careful buying into that. You're buying into momentum that's going against you on the higher time frames, and you got to wait for those lower time frame trends to shift back up to give you enough confidence that you can actually take a trade to the upside right now, since you're trading against momentum on higher time frame. Now, once we can recapture point of control to the sell side, that means once you have arguments to support that you can sell, what you're doing is you're going back into the momentum of the daily and the 4-hour. You're going back into that strong sell-off momentum. That means your potential is a lot bigger, where you could catch a bigger trade to the downside if you're following that higher time frame momentum. Correct, Joy. Ride the trend. Now, technically, the trend is bullish, but if we go back and we're using the concept of premium and discount, and we look at higher time frames, we know that the daily is currently bullish, but it has a long way down, right? A long way down before it has to worry about support. It could come all the way down to here. Okay, so if I draw that like that, and then I go back down to the 1 minute. Okay, let me zoom out. You can see how funny these lines look when you change time frames. Look at that. Whoa, that line keeps going here. Whoa. All right. So let me show you this here. Okay. So we're looking for potential here. So look at this. You want to see how big the potential is to the downside on gold if you were to take shorts? Look at this. Look how far away that line is. That's your potential for a sell. Compare that to the potential for a buy. If you take a buy early market open, like earlier in this upcoming week, you could come up a little bit up to here. But looking at the higher time frames, if you're going to catch a move at the very top on the daily, you might as well hold on to that sucker and ride it down all the way to this level, way down here. And that's very reasonable, right? Doesn't mean you have to only take one trade and that's it and wait all week. That could be 1 or 2 weeks to get down to that level. It just means that you can take a position. Once you're in the clear, go to break even and just leave it alone. Forget about it. And then move on and start looking for additional lower time frame trades. But I love talking about that, guys. You could grab a sell somewhere up here and hold on to that for a massive, massive gain if you want to. If you want to go for a big swing like that, you don't have those opportunities very often. If price gets back up into here, you're going to have that opportunity to take a huge swing trade to the downside on a sell, right? So to Lita and Christine, let me know if that makes sense on when do you get in? When? Well, my thoughts are you should mark out your structure because everything should be based on structure. You got to have clarity And usually you have to zoom out to the higher time frames and then start narrowing it down into the lower time frames to see where are you at truly in the now picture and in the bigger picture, where are you at, to give you an idea on the timing of when to get in and which levels need to be achieved before taking that trade to give you confidence. Yes, great. That was that was like a 40-minute training of something that if you practice this, you'll get this down to just 5 minutes. I do this every day. Every day. I actually blank out my lines every day and I go back in and I mark it back up. I'll do it on gold and I'll do it on NAS. And it just takes like 5 minutes each chart. It's no big deal, right? To take 10 minutes and mark up your charts for the day. It's worth it. It really gives you a clear outlook on where you should be waiting for price to get to. And why do I erase the lines and redo them every day? Because every day you have a fresh set of eyes, right? I erase all the markups because if you have like 20 markups on your chart, because you're measuring all these levels, you could start to become fatigued and you could become disillusioned. And it's always good to wipe the slate clean, clear your charts out, make them empty and naked, and then go back in and do it again and set it back up. If you did this every day for 5 minutes or 10 minutes, your guys' accuracy would be through the roof. Your confidence would be through the roof. Your risk to reward would be through the roof. Now, my stats, I don't think they're crazy impressive, but I think they're pretty good. I just shared my stats in the Discord under the profits and testimonials. You could see I'm averaging about a 3.5 RR on my trades. To me, that's great. That's the best I've ever done. That means my average trade wins 350% more than my average losing trade. And that's a statistic after 37 trades. That means that's not just a 1 week fluke. No, I'm maintaining a 3.5 times risk to reward. That means I could lose 3 trades in a row every single time, and all I need is one trade to win, and I'll stay profitable. So think about that. What does my win rate have to be, guys? If I can afford, based on my risk to reward statistics, if I can afford to lose 3 trades and only win one trade out of every 4 trades, what's my required win rate to be profitable? 70%? I'd say try again. Okay, out of every 4 trades, if I can lose 3 of them and only win one and still be profitable, then what's my win rate requirement? Correct. Chris, you got it. That means my trading plan allows me to lose 75% of my trades and I'm still profitable. That means my P&L is still green at the end of the week. I'm making money, I'm making progress. I can still pass prop firms. I can still get payouts. I can still grow my live accounts, even though I'm only winning 25% of my trades. Why? Because of my risk to reward. Okay, how am I getting that risk to reward? That's awesome. By doing this right here, what I just showed you, using these levels, knowing my potentials. Because when the potential's bigger, I can hold on to that trade longer, which increases my risk to reward to keep those stats going up. Now, what's my actual win rate? I can afford to lose 75% of my trades and only win 25. What's my actual win rate? Right now, my win rate is 67%. So I'm 2.5 times higher on my win rate than the minimum that I'm required to maintain to be profitable. That means I'm super profitable. I'm only losing 33% of my trades. I can afford to lose 75% and still be okay. I'm nowhere close to that. And again, that's nothing special. A 3.5 times RR average, that's pretty good, especially being maintained over a longer period of time. That's pretty good. It's not crazy. I've seen better, But to put it simply, I'm not doing anything special. I'm just marking up my charts. I'm looking at these levels, and then I'm targeting those areas for price, right? That's what I did on, I showed you guys the gold trade. I know, Lita, you caught that on one of your paper accounts. That gold trade that I shared on Thursday night, that's all I did. I just went real quick, boom, 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 marked up the charts and said, okay, this level's protected. We just got a nice change in state on the 15 and 30 for the upside movement. And I'm gonna trade that retest level right there. Boom. That trade was a 1 to 3. It went right along with my trading plan. Now, here's what's funny is Thursday night when I called out that buy on gold, everybody that I follow online, like on TikTok, all the good traders, everybody was calling shorts on gold. And I'm not gonna lie, that caused me to doubt myself a little bit because I'm like, oh my gosh, all the retail traders that I follow are all in shorts on gold, but I'm looking at longs. Like this thing is gonna go up. I don't see it going down right now. It's all about timing. Like, yeah, overall, we're looking for shorts in the big picture, but you can't go based on the daily time frame in the 4 hour. You got to zoom in. And based on the lower, the 15 and the 30, we were gonna go up according to my analysis, right? I've learned over time to block out that noise. You have to block out that noise. Okay. So if you're following other traders, even me, if I say something that goes against your trading plan and you're like, oh, Sal, I just don't see that. Right? Like, for example, Joy, you might have a different analysis than me because you're using the three-step distribution model, and I'm using just a more of a simple structure trading model. They both work. They're both very profitable. They both have a clear edge over the market. There will be times where those two philosophies contradict each other. There's going to be times, Joy, where you're looking for longs and I'm looking for shorts. And there's going to be times where I lose and you win and vice versa. I just like remember that trade about a week and a half ago. I still remember that awesome trade where I called shorts on the market open call and you were looking for longs and we both won. I won the short on the way down. You caught the long going back up. You remember that trade? Right? That means they both work. That's what's awesome. So because you know that multiple trading strategies can be successful, that's where you should have confidence to just trust your trading plan. Whatever it is, you first off make sure you have an edge. If you're following the three-step distribution model, there's a clear edge there. You know it's a very high win rate. Ryan's win rate is a lot higher than mine. I'm averaging 67%. Ryan is averaging in the high 70s. I trade way more than him though, right? Like this month I've taken 37 trades. Well, not this month, but within the last month I've taken 37 trades. He's probably taken like 4 or 5. Way different, way different. But they both work and they'll both allow us to be positive at the end of the month. Right. Yeah, the V strategy, like you're talking about the V-shaped recovery. For sure, Joy. I'm gonna keep teaching it. I'll keep calling out trades. Do you have the AIO software, Joy? Are you in the inner circle chat? Okay. I share my gold trades in the inner circle chat, which comes with the software. But in general, yeah, gold does move way different than NQ. It's not as impulsive as NQ. It likes to range. It goes on much longer trends, and it also has more retracements. I always say this: if Forex and the Nasdaq had a baby, it'd be gold. Gold is a combination of how Forex moves and how Nasdaq moves. It's a really great instrument to trade. A lot of people are scared of it. It's like they like to trade it, but people are scared. And I'm like, guys, there's nothing to be scared of. It's just an instrument. Like all of that is just emotion. It's all in your own head if you're scared to trade something. If you're protecting yourself and you're following your plan, then there's nothing to ever be scared of. But it's a great instrument and it is good to diversify, Joy, just because sometimes NQ is very choppy. it's not a good time to trade, or you're waiting for price to get to a key level. And during that time, gold might have a really good setup. Yeah, exactly. Yeah, I agree with you as well, D. Yeah, it's fickle. Gold does fake people out. Gold also likes to have a lot of double tops and triple tops and double bottoms and triple bottoms, meaning it likes to retest the same area. And why is that? That's because there's a lot more liquidity on gold than there is on NQ, right? So understand liquidity is what drives price. The less liquidity that's available for an instrument, the fewer times price will retest the exact same level. And then vice versa. The more liquidity that a market has, the more often times that that asset will retest the same levels. Why? Because there's more orders sitting there that didn't get picked up, right? So if there's a good sell level for gold, it's going to hit that level two, three, four times in a row before finally selling off to the next level, because there's so many orders going in on gold that the market needs to fill all those orders and meet all of that demand. Versus NQ has much less liquidity. Why? Because it's a US asset. So a lot of international volume doesn't touch NQ, but the whole world can trade gold, right? And that's why Forex is so rangy. Forex is so slow. Forex can retest a level 6, 7, 8, 9 times. And it's like, holy crap, when is this thing gonna move? It's because there's so much liquidity. It's a $7 trillion a day market. That means there's so many orders that need to get filled that it takes time to fill the orders. It takes time for the price to move. You got the banks all around the world with the most amount of money, right? You got retail traders, you got hedge funds and institutions, smart money, and then you got the banks, the central banks. Who do you think has the most money out of all those groups? The central banks. And what do they trade? They trade Forex, right? They're constantly going in and out of different currencies. So that's why it takes longer to get through all those orders, because they got so much money on the line waiting to get filled. And that sounds like a sucky thing, but there's always a paradoxical edge to that. There's always a good side. What's the good side to it? Is that Forex goes on massive trends. You could be in a trend for 3 months on Forex. If you catch the trend like a buy or a sell at a good place, you could hold that for months and just kill it. I see traders do that all the time. They make multiple six figures, some even seven figures trading Forex. And that's because they'll take a big trade and they'll let it run for like a month, because it just goes and goes and goes. And it's very, I would say, very stable. Forex is very stable. Now, with Forex, because it's so big, you have to trade off of higher time frames. You cannot use the 1 minute, the 5 minute, the 15 minute to trade Forex. In my opinion, you just can't. Why? Because it's gonna slice up and slice down so many times to get to all these orders that have to get filled, that there's no reliability or consistency on the lower time frames. It'll drive you crazy. So Forex, you gotta go. It sounds funny. You gotta go to the monthly time frame, the weekly time frame, the daily time frame, the 4 hour. Your entries could be based on like the 1 hour or the 30 minute, right? Versus gold, you could get away with daily, 4 hour, and 1 hour analysis, getting in on the 15 and 30. In Q, you only have to look at pretty much like the 4 hour and the 1 hour and the 30, and then you get in on like the 15, 5, or 1. That's what makes those different categories different. So, all right, ladies and gentlemen, we are at the 1 hour mark. Thank you for those of you that show up live. I hope that this training was valuable for you guys. Let's see, Majid is saying gold has been great with the alerts and liquidity target. Yeah, I agree, Majid. That liquidity target, I mean, I know we say it, but I still think it doesn't get enough credit. I mean, man, that thing is so simple to use and it's so reliable. It's so accurate. Ugh, I love it. And I have a surprise coming for you guys this next week. I always have surprises, but I have something really cool. Um, I'm trying, I'm pushing to help the newer traders in the community who don't have a handle on structure yet and they feel a little bit lost, I'm working on something to make it super simple, even more simple, where it's like a lot more like immediate entries. And I'm gonna keep calling out more trades with you guys. I want to trade with you guys. I'll keep showing you my trades. So let's do it, guys. I'll see you next week. Have a great rest of the weekend, and I'll see you Monday morning for the next market open call. Blessings to all of you guys. Thank you.